Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Now we are going to take a look at a comprehensive test of our understanding to encompass everything that we have discussed on group accounts. So ED's group runs a business of manufacturing organic food spices. So on 1st January 2017, ED's acquired 800,000 of the ordinary shares of Kyra for $1.8 million. Kyra's retained earnings at that date was $950,000. So no shares have since been issued by Kyra. Also on 1st January 2019, ED's acquired 2.7 million of the ordinary shares of Marilyn for $8,650,000. The retained earnings of Marilyn at that date was $4 million. No shares have been issued by Marilyn since ED's acquired its interest. So the accounts for all companies are made up to 31st December. The draft income statement for ED's, Marilyn, and Kyra for the year ended 31st December 2019 are as follows. So we have revenue for the three companies, we have the cost of sales for them leading to gross profit, we have distribution cost, we have administrative expenses, we have finance cost for ED's, none for Marilyn and Kyra, we have profit before tax, the resulting figures, we have income tax for the three companies leading to the profit for the year. Then we move on to the statement of financial position as at 31st December 2019 for the three companies. So we have the property, plant, and equipment for the three. We have EDC's investment in Marilyn listed here. Also, EDC's investment in Kyra is also listed. And we have current assets for the three companies, which will give the total assets for the three companies listed. Move on to the bottom side of the balance sheet. We have ordinary shares of the three companies, which will only pick that of the parents. Okay, we have retained earnings for the three. Then we have current liabilities, also providing the total for the bottom figure, corresponding to that above. In additional information relating to ED's, Marilyn, and Kyra, the first is that the fair value of a net asset of Marilyn is $150,000 more than its current value. Okay, so here we have fair value adjustment. So the assets had a remaining useful life of 3 years at the time of acquisition, which means that there's supposed to be an additional depreciation to be considered. The second additional point is that during 2019, ED's made sales of $200,000 to Kyra at a profit of 20% on cost. $50,000 of these goods are in inventory as at 31st December 2019. Unrealized profit comes to mind. The third point, Marilyn also sold goods with cost of $100,000 to ED's at a margin of 40% within the year. Now, 1/3 of these goods are in inventory as at 31st December 2019. There's also an unrealized profit to be considered here. $100,000 of the payments is still outstanding and included in the current asset. Okay, so there's a receivable and payment in the group relationship here, which must be eliminated. The next one is that on 1st January 2019, ED sold an equipment to Marilyn for $240,000. Marilyn had included this equipment in its property, plant, and equipment. That equipment had been purchased by ED's for $200,000 in October 2018. The profit is included in distribution cost. There's also an unrealized profit, but here it is on non-current assets. Now, it is good policy to charge full depreciation in the year of acquisition. Depreciation rate for the group is 20%. Next, it is the group's policy to value the non-controlling interest at fair value at the date of acquisition. Now, the fair value of the non-controlling interest in Marilyn on 1st January 2019 was $500,000. So we are required to prepare for the ED's group 1. Consolidated income statement for the year ended 31st December 2019. Then the second one is that the consolidated statement of financial position as at 31st December 2019. In solution, we are first supposed to test the holding or the standing of each of the companies that have been bought, whether they're supposed to be consolidated or not. So we first test the group structure. Okay. So in doing so, when we come to Marilyn, in the question it is stated that ED's bought 2.7 million of its total shares. Marilyn's total shares is 3 million. So it means that Edie's holding in Maryland is 90%, which makes Maryland a subsidiary of Edie's, meaning it's supposed to be consolidated. When we come to Kyra, Edie's bought 800,000 of the total shares of Kyra. The total shares of Kyra is 2 million. It means that 40% is the holding, making Kyra an associate. So now that is done, we move on to solve the consolidated statement of profit or loss for the year ended 31st December 2019. So we introduce the headings because Kyra is an associate. We don't feature its heading here or its figures. So we first bring the revenue. For Edie's, it's $45,600,000. There are 3 zeros above. Then for Maryland, it's $24,700,000. Then there was an intra-group transaction. Transaction figure was 166. So we eliminate that, giving a group of $70,134,000. When we come to cost of sales, we pick that of Edie's, which is $18,050,000. Maryland, we add that to it, $5,463,000. Then there are certain figures that will sum up to the $240,000. The workings will be shown in the next slide. It will lead to a cost of sales group figure of $23,272,000. Now, when we come to the gross profits, for Edie's, $27,550,000. For Maryland, it is $19,237,000. Now, when we come to the group, it is essential for you to sum vertically, not horizontally. So you subtract the $23,272,000 from the $70,134,000, giving $46,862,000. If you do it vertically, you might get a lesser figure, okay, because it will not encompass the adjustment that has been made here. Now for distribution cost, it is $3,325,000 for Edie's, $2,137,000 for Maryland. We eliminate the unrealized profit arising from the transfer of the non-current asset from Edie's to Maryland. It will lead to a group distribution cost of $5,402,000. Now, administrative expenses, we add that of Edie's, which is $3,475,000, to the $950,000 of Maryland, leading to a group of $4,425,000. Then finance cost, it will be $325,000 for Edie's, none for Maryland. Okay, if there was a figure for Maryland, we would have to work out the one attributed to Edie's, which is the parent, and eliminate it. Then we'll bring in the share of the associate's profit, $4,460,000. Okay, it will lead to a profit before tax of $24,885,000 for Edie's, $16,150,000 for Maryland, then $41,170,000 for the group. Okay, again, it's essential you sum vertically, not horizontally. Okay, for income tax expense to be $8,300,000 for Edie's, $5,390,000 for Maryland. Then the group will be a figure of $13,690,000. Then the profit for the year, it is $16,585,000 for Edie's, $10,760,000 for Maryland, then $27,480,000 for the group. Now let's look at the workings which featured in the profit or loss account. The first we look at is the cost of sales. So the unrealized profit where Edie's sold to the associates, okay, workings one will provide that very soon. Then we have unrealized profit where Maryland sold to Edie's, workings two will also provide that. It was $22,000. Then intra-group sales, the one that Maryland sold to Edie's, the transaction amount was $166,000. We'll also provide solutions or the details to that very soon. Then additional depreciation, the fair value adjustment of $150,000. It said it had 3 years remaining, so we have to depreciate that. Then we add it, giving $50,000. Okay, then the cost of sales is seen here. The next is the parent share of the associate profit. It will lead to a figure of $4,460,000, which was arrived at as taking 40%, which is the parent holding in the associate, on the associate's profit after tax, which you can find in the draft statement of profit or loss. Okay. Now let's look at the consolidated statement of financial position as at 31st December 2019. Okay. So we start with the property, plant and equipment. We pick that of the parent. We add that of the subsidiary, which is $18,758,000. Then we add the fair value adjustment, the $150,000. Okay. Now we less the depreciation. Okay, you have 3 years to go. You have to charge 1 year's depreciation because it's a year after acquisition. Now we have to less the unrealized profits. This 60,000 is inclusive of Marilyn's property, plant, and equipment. So we less it from here. Then we'll less it from the profit of Edith, who is the parent. It will lead to a group of $50,531,000. We'll show all workings very soon. Then we come to the investment in Kyra, which is step 6. So we lifted that and brought it here, $6,257,000. Then we have Goodwill, step 3. Also we lifted it and brought it here, $2 million. The current assets, we add that of the parent, which is $1,568,000, to the subsidiary of $9,025,000. Then we less the intragroup current balances. Okay, so there was 100,000 outstanding, which will be a receivable to the seller. We have to eliminate it. And we also eliminate the unrealized profit, which was $22,000, showing in workings 2, because the subsidiary sold to the parent. So the parent has it as part of its inventory, which is featured in current asset. It will lead to a figure of $10,471,000. Okay, so it will lead to the total asset of $69,259,000. And we come to the bottom part. First is ordinary shares. We only pick that of the parent, remember. Then we come to retained earnings, step 5, $34,654,000. You lift it and bring it here. Then we have non-controlling interest, step 4, $1,569,000. Then we have current liabilities. Pick that of the parents, $13,063,000. Add that of the subsidiary, which is $10,023,000. Then we less the payable, the intra-group balance. Then it will lead to $23,036,000, which will lead to a balance for the bottom side of $69,259,000. When we come to the workings, the first is the group structure. So we have to estimate the various holdings in the investee. The first is Marilyn. Marilyn, as we have already known, it is held 90% of its holding, making it a subsidiary. It is held 40% of the shares of Kyra, making it an associate. We come to step 2, the net assets of the subsidiary. We'll look at the net assets at acquisition and reporting dates. So the first thing is the ordinary shares. It was 3 million at the beginning. None was issued, so still 3 million at reporting date. Then we come to retained earnings. It was 4 million at acquisition, and it was 40,760,000 at reporting date. We come to fair value adjustment, the excess of the fair value of the net asset of Marilyn, 150,000 at the beginning. It will still be 150,000. Okay. Then we calculate the depreciation. It was not supposed to be at the start of the year, because depreciation is charged as the year goes on. So we only charge it at the end of the year. Then we have unrealized profit workings 2, because Marilyn sold an inventory to the parent. That will lead to a total of both sides $7,150,000 at acquisition and $17,838 at reporting date. So it will give us a post-acquisition reserved of $10,688,000 when we strike the difference between the two. When we come to Goodwill, we take the cost of investment of the parent in the subsidiary, which was $8,650,000. The fair value of the non-controlling interest, as stated in the question, is $500,000. Then we less the net asset of the subsidiary Marilyn at acquisition from step 2, the left side. It was $7,150,000. It will lead to a goodwill figure of $2 million, which will be taken to the consolidated statement of financial position, as we saw. This is the step 3. Okay. Now, when we come to non-controlling interest, the one we saw after the retained earnings in the equity column, okay, we start with the fair value of the non-controlling interest at acquisition, which was $500,000. Then we bring its share of the post-acquisition reserve of Marilyn, the subsidiary. If the parent has 90% holding, then the non-controlling interest will be the difference, which is 10%. Strike that on the post-acquisition reserve of the subsidiary. It will give $1,069,000. Then we arrive at a non-controlling interest of $1,569,000. Then we come to step 5, group retained earnings. So we start with the parent retained earnings found in its individual financial statement, which is $20,638,000. We bring its share of the post-acquisition reserve of the subsidiary, 90% on $10,688,000 will give $9,619,000. Then we bring the parent's share of the profit of the associate. So when we multiply 40%, that is the holding, on the profit after tax of the associate, it will give $4,460,000. This is the same figure that was recorded in the group statement of profit or loss. Then the unrealized profit, the sale where the parent made to Kyra, we will take it out of here. Then we'll take the same figure from group 6. Then unrealized profits that the parent made to Marilyn. Okay, so some inventory to them. So we have to take it from here, which is $60,000. This is the same $60,000 that was eliminated from the distribution cost of the parent in the consolidated statement of profit or loss. So it will provide group retained earnings of $34,654,000. And lastly, step 6, investment in associates. We'll start with the parent cost of investment in associate. It was $1.8 million. Then its share of the profit after tax, which was $4,460,000. The same seen in step 5 and recorded in the profit or loss. Then we will take the unrealized profit. Okay, because the associate now has the inventory, it has to be eliminated. It will lead to an investment in associate. We move on to look at further workings. We'll look at the workings of the unrealized profits. So here, the parent sold to the associates. The amount of inventory unsold was $50,000. The profit element, because the profit on the cost was given us 20% and the selling price was provided, it will be 20 over 120. That will give us the profit on the unsold element. But with associates, we only have to eliminate the parent portion. The parent had 40% stake, so we just find 40% on the entire profit on the amount outstanding. So this 3,200, when you run it up, it will be 3. It was subtracted from the cost of sales. It was subtracted from the retained earnings of the parent. Okay, step 5. And also subtracted from step 6, the investment in associates. When we move on to unrealized profit, second one. Here, the profit on sale of the entire transaction was $63,000. Okay, they provided the cost and provided the margin. Okay, so you just find 40 over 60 times 100. It was said that 1/3 of the goods were still outstanding, so we just find 1/3 of the profit on the sale, which would be the unrealized profit. Now this unrealized profit, because it is the subsidiary that was selling it, we deducted it from the cost of sale. Okay, in the profit or loss section. We also deducted it from the net assets of the subsidiary. And we deducted it from the inventory in the consolidated statement of financial position. Now, because the cost price was given, to find the selling price, we add the profit to the cost, giving $166,000. If you look at the breakdown of the cost of sales, this is how come we got the $166,000. It has to be reduced from the revenue, then reduced from the cost of sales. Then the last unrealized profit, which was made on non-current assets. Okay, here the parent sold to the subsidiary. So the current value after sale was $180,000. The assets was sold for $240,000. A year has elapsed. The asset had 5 years. The asset had been used for 1 year, so it was left with 4 years. 1 year has elapsed after sale, so it will be left with 3 of the 4 years. Okay, then if the asset has not been sold, it would have been $120,000. The asset was bought for $200,000 and was supposed to be for 5 years. 1 year had been used prior to sale. After sale, it has also been 1 year. So it will be left with 3 out of the 5 years. Okay. So the unrealized profit, which is the difference, will be $60,000. Since the parent was the one selling, we took it from the distribution cost. Because it's not inventory, we don't take it from the cost of sales. It was also taken from the step 5, the group retained earnings. Okay, then it was taken from the non-current and the PPE of the subsidiary. Okay, people, this is where we bring our discussion to a close. I hope it went well. If you have any comment or feedback for us, do well to drop them in the comment section below, and it will be timely and adequately addressed. Whilst at that, kindly subscribe and turn on all notifications. Also, follow us on our various social media handles as captured on the screen. Catch us again on another episode of Tutorials on the Go. Till then, take care of yourself and stay blessed. Poker.